We're going to see another housing crash soon. I feel like I hear this question almost every day and have probably since 2010. Hey, what's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online as usual. Today, I've been noticing more and more people are starting to talk about a crash. This has been going on for literally over a decade. I started in this business, just prior to, or just a couple of years prior to the 2008 crash. And I understand why a lot of people still have, a lot of feelings about that and a lot of worries. But, like you can just see article after article about this coming out. When will the housing market crash? This was just, I think, 3 or 4 days ago. Um, Okay, 5 days ago. We've got, this one just 3 days ago. Is the housing market going to crash? Here's what experts say. I mean, you can really just go on and on. The U.S., in the biggest housing bubble of all time in 2025, larger than 2026. Again, this one was just last month. But these just keep coming out. Um, I know I had this conversation with people in 2017, 18, 19, they were hesitant to buy. And if you waited back then, you'd still be waiting. You'd have missed out on a whole bunch of great returns. And then you have people, these are a couple of my favorite YouTubers. They bring up this discussion about the crash a lot, but here's, I would love a crash, and I think a lot of real estate investors feel that way, depending on what your portfolio looks like today, how much liquidity you have. After 2008, there were deals everywhere. And so a lot of us do think, hey, yeah, especially if you have more money than you had back then. Like in 2008, I was really new to the business, didn't have a ton of cash, saw deals everywhere, and didn't get to buy nearly as many as I would have liked to. I think if we get a crash this time around, it's going to be, it would like if we had something similar to that, it would be amazing for my portfolio. Now, I don't think, it wouldn't be amazing for the country. I'm not saying I'm hoping for that, but I also don't think that's, that we'll see one to that extent. I mean, I think it would be obviously if you listen to this reventure guy, but he, if you really dig into his data, it seems like he just cherry picks so much. So, whether or not we're going to have one, I don't know. This is one of my favorite quotes about investing. This is just McKinsey's quote of the day. I actually was looking for where, I Googled this, and this has just happened to be one of the places where I found it. I think, hey, this is actually a relatively legitimate place to find this, right? They're pretty well thought of in the marketplace. And being right too early is indistinguishable from being wrong. If I know something's going to happen in the market, but I'm 5 years too early, it's the same thing as being wrong. And so definitely this guy has been wrong for, I don't know, at least 3 or 4 years. Probably five by now. I'm not even sure, but I've seen his stuff for a long time. And so, has cost a lot of people a lot of money who have listened to him. But anyway, uh, I really am not here to tell you, whether or not I think there is going to be a crash, because in my mind, you have to remember, if you have thought much about, or if you've been watching me for a while, you know that my business model is based very much on never having to be right about making a prediction about anything, right? I'm very much a um so we talked about this in one other episode, or I don't know what to call these, but quite a while back, one other video I posted, where basically, there's two types of investors: those that think you can know the future, and those of us who are right, who know that you can't. And so, people who think you can know the future, they make up their mind about what the future is going to be. They place a bet on what that is. Um, and then, when they're right, they make a ton of money. When they're wrong, they lose a ton of money. The people that happen to get lucky and their bet was right, because a lot of it is based on luck especially in the short run. If you've only been investing, 7 or 8 years or so, especially if it's in the stock market or something. But if you've only been investing that long, a lot of your results are probably, you don't have a big enough sample size yet to know if it's skill or luck, right? And uh, but what my goal is to always take as much luck out of the equation as possible, not have to be right about making guesses for the future. Um, and so the way to do that is, one, this is why we talk about quite a bit is, focusing on the fundamentals of of what we're investing in. And for me, it's fractional real estate, and I'm talking about the fundamentals of the property. Trying to buy, uh, not trying to predict which deals are going to have the greatest upside, but um, trying to weed out ones that have the potential to have a great or negative downside, or are just not structured in a way to protect, for a downside. So, like for example, one of the things that when you look at moguls deals, their yields, their stated yields, are not nearly as high as the yields on a lot of the lofty deals that you see come out. Um, One of the big reasons for that is they are raising massive reserves for each of the entities, right? Like they basically raise enough of a reserve that they can have virtually zero income for the first full year, even though they're buying properties that are currently actively operating. Um, when you do that, and then you look at your cash on cash return, well, you're raising a lot more cash than you needed to, depending on who you are, how you think about need. And so it's going to nerf that return, right? But uh, if you think about, the stability or the fragility of, one model or the other, having that really hefty reserve, I think just protects you. And so it's going to make the actual yield lower, um, but it's going to make it a much more durable yield. And so thinking about all of this reminded me of this quote. I don't actually think this is a Howard Marks quote, but that's who I've heard it from. He's the founder of Oak Tree Capital, but also, the guy who wrote my favorite book that I always have with me. Um, he mentions there are old investors and there are bold investors, but there aren't old, bold investors. And I think that this is really true because you can make these wild bets, and if there's a lot of people in the marketplace making these really large prediction heavy bets, at any given time, a large percentage of them are going to be right, especially if it's a binary thing. Half of them are going to be right. But if you continue to make bets based on predictions, each time you're going to lose some of those people because they're not going to be right over and over again. And you might have people that were right 10 times in a row and they were right for the wrong reasons, right? So there's a lot of times where I really just, and I'm only talking about the crash stuff because it just keeps coming up with people I'm talking to, and more so lately, I think we're having another little wave of this discussion, and I don't care. I mean, it makes like I have absolutely, I don't try to predict when the crash is going to happen. I do think trying to understand a little bit about where we're at in the cycle makes some sense because, although, like I said, I do think this is cherry picked data to make it look, he's usually using data that really skews numbers quite a bit. And I don't know, I didn't dig into this chart, but I just have seen a lot of stuff from this guy. But regardless, like, it's good to understand, do I think I'm closer to the top of the cycle or the bottom? But, trying to predict, like, if this is going to happen next week or next year or 5 years from now, is really a loser's game, right? Like, there's just no, like, okay, if you got it right, that's great. Um, but it's not, you could have just as easily gotten it wrong because there's so many things that go into the actual outcome of this. And again, remember, being too early is the same as being wrong, right? And so, and why is that? Well, if I decided like there's going to be a crash and I'm going to wait to buy, uh, then I'm missing out on the returns between now and whatever it moves up to. And so one of the things, that we could certainly have a crash. Like prices have come down in a lot of markets. Like for example, Austin is a market that the prices have come down quite a bit, but they haven't come down below 2019 levels, right? And there have been people sitting out longer than that. So depending on the time frame that you're looking at, you could certainly have missed out on more upside than how much downside protections that you're getting. Um, but so, okay, if I don't care about this stuff, why am I even bringing it up? Well, I think the right thing to do in my mind, and again, this is the way I look at it. You can do things differently. Before I forget, please like and subscribe. In the description to this video, there are links to all the places where I currently invest on fractional real estate online. Do your own due diligence on those platforms. Just because I invest in them doesn't mean that you should. The same thing with any of the properties that you see me buy on there or on any of the platforms. Just because they're right for me doesn't mean that they're right for you. And when I am talking about properties and deals, I am a licensed agent in Texas. I'm not your agent. I'm no longer an attorney. I retired my license. I'm giving you the extra disclosures today because I've gotten a whole bunch of new people to my channel lately, and so I'm trying to make sure that everybody realizes what I'm trying to do here, right? I'm trying to share the way that I think about investing in these deals, my thoughts on, specifically on how to go about buying, selecting properties, like the things that I care about, the things I'm worried about, and the things that I don't, I'm never going to try to predict, okay, uh, where are interest rates going? Who knows, right? Oh, and that's one I didn't put on my list. But so all these things, I think are things we can't really control and shouldn't worry about. But what we can do is be very defensive investors, pick properties that we think should be able to weather a storm better than other properties. And so I've got a list of things that I wanted to talk about. So the very first thing, and I already mentioned this, is reserves, right? One of the reasons I like Mogul a lot, they fund extremely hefty reserves, and I do have a link to Mogul in the description, like I mentioned. If you haven't seen that, every deal that they do, that it's something that if you don't, they're really, it's just they're taking a very, what I think is a very conservative approach to reserves. Where, for example, on Lofty, you do have reserves on in some of the DAOs, but on any given day, you see somebody proposing a vote to just cash out the reserve to people that own the DAO, right? And sometimes they're keeping such minuscule reserves, and when it gets over a certain amount, they just are like, okay, well, everything more than that, let's just give it to us. Or sometimes they're reinvesting with it, or sometimes they're burning tokens. But the approach to reserves on Lofty is terrifying to me. And you would think that most of the people that invest on there would understand that it's a problem because um, a lot of the DAOs have already had liquidity problems where they tried to raise money. The Lofty came up with this universal lending DAO to try to lend money. There's always capital calls going on, and um, you know, especially whenever we do end up having an eventual downturn, that capital is not going to be there for capital calls the same way that it is today. And even today, it's not as available as it was once. There's a lot of investors who have been burned on there, and they don't want to throw good money after bad. I always forget if that's it or if it's bad money after good, but they don't want to, keep investing in a deal that's not doing well. So, the way that so that's one of the things that I pay a lot of attention to is, okay, how are we handling reserves? How are we funding them, right? Is it just, okay, we do an upfront funding it, and then are we continuing to keep that funded out of cash flow? Um, which is not the default on Lofty, which is mind blowing, right? Like they fund a reserve when they bring a property, they blow through it, they add to it through trading, which just creates this extra friction from buying and selling. It makes it a little bit more difficult to make money. But anyway, reserves, number one thing that I want to think about and look at. The next thing is the debt coverage ratio, right? Your debt service coverage ratio. This is one where I'm always looking at the income from the property relative to the debt that's on the property. On Lofty, a lot of times the DAOs aren't paying that mortgage. It's being paid by a third party, the co-owner who brought it to the platform. And so people just tend to ignore the debt service coverage ratio. I think that is extremely foolish because there's often situations where the Dow end up having to pay for that mortgage. And then if there's not enough income from the property to pay that mortgage and then some, you don't have any sort of cushion. And so that's another thing like on Mogul, they're using they always have a pretty healthy debt coverage ratio, or debt service coverage ratio. So I feel, but it's something that I'm looking at on every deal. And if it's a little bit tighter, or if it's tight relative to the business model or the market, these are all things that none of them, I don't have a specific standard in a vacuum, right? All these things go together, like, and you have to weigh the whole thing. It's not just, okay, is this number X? Okay, we're good, and let's move on, right? Like maybe if I have a little bit lower debt service coverage ratio, but I really believe in the asset for some reason, maybe I'll move forward for it if I have much higher reserves or some other things that we're going to talk about. Um, Another thing is our counterparty risk. This comes up more with Lofty than anything else. As I just mentioned, sometimes you have the co-owner who brought the property to the platform. They're actually responsible for paying the mortgage. Also on Lofty, sometimes that co-owner is providing a rent credit. In both of those scenarios, that person is a counterparty to us as the DAO, right? They're selling us equity, and their interest that we buy, and they're providing some guarantee of future payment either of the mortgage or of this rent credit, or any number of other things. And this is one thing. Whenever these pop up, I'm always like, well, what do we know about this owner, right? Or what do we know about the co-owner? How do we know if they're going to be able to pay this or not? And so there's a lot of risk there. We don't have that same type of counterparty risk on most of the other platforms. Um, and I guess I talk about Mogul having good reserves. Some of the other, you have like Arrived and Arc 7. They're also funding reserves. Like it's not like Mogul's the only one. I think they have some of the healthiest, but I think that they're just one that I'm actually invested on, where the others that I just mentioned are, relatively worse yields, at least their stated yields, right? And so I haven't invested on either of those other two platforms. Um, what the business model is, right? Like, so is it a co-living rent by the room? Is it short-term rental? Is it long-term rental? Those different models are going to behave much differently in a downturn, right? It's one of the reasons why um, I'm a little bit more bullish on the co-living than anything else right now, because that's providing truly affordable housing. And in a situation where a lot of people's incomes are going down, or going down relative to inflation, or however it works out, there'll be a lot of people that can't afford an apartment, and definitely can't afford travel. So maybe STRs are not doing so well. But renting a room becomes a really, a really good option for a lot of people. And so yeah, I think that is, it's a good, whenever people say it's a recession-proof business, it really worries me. But I think you could label it as recession resistant, and I would be comfortable with that, right? I think it's one that may even benefit from a recession, depending on how deep it is and what's going on in the local economy and whatnot. Um, and then speaking of the local economies, the market growth, the market vacancy rate, all of these market factors that we like to look at, like if it's a market that's growing right now and that has a track record of growing, those markets have a better chance of, continuing to do well, as the general economy declines, right? And so one of the things, where when you have sort of major recessions, a lot of the markets that people were sort of forced into because of everything became unaffordable, a lot of people are going to leave those because all of a sudden they can afford some of the better markets again. They're going to, like they're so I think this happened. I feel like a lot of the Rust Belt resurgence, for investors at least, has come from the fact that it's one of the only places where deals could be, on paper at least, look much better cash flow wise. well, talked quite a bit about how some of that is really just on paper, because of a number of issues, but not always. But I think that as other markets could become a lot more attractive, um, and this is kind of weird to say, right? Because like, well, they'd only become attractive if they did have a little bit of a dip. So maybe that's counteracting my point. I'm not really sure. But again, having a growing market just means that your demand side is going to be strong. Having a very low vacancy rate in your market, I think, is helpful because as it creates there's more slack, right? If the vacancy rate goes up a little bit, if you're starting at 5 and you go to 10, that's not nearly as bad as if you're already at 10 and you're going to 15 or 20. And then, one of the other things that I think we should always look at, and it seems like a lot of people ignore, is the current condition of the property and the need for like future capex, right? Like, so, okay, we already talked about having reserves for that capex, but like, how much are we actually going to need, right? Do we have a beat up old roof? Do we have a 30-year-old furnace? Do we, like all of these things, like the mechanicals of the property, understanding, what their condition is, when there's repairs are going to need to be made, if there are other hidden defects or and if they're hidden, obviously we won't know, excuse me, but we might have a better sense of um, you know if you have a 150-year-old home in a floodplain versus a 20-year-old home in an area that you have none of that type of risk, um, the chance of having condition issues pop up are going to be less, right, in the latter situation. So I think that, those are all things that I think apply across the board. But then also I want to talk about some of the things specifically for SDRs because I mentioned maybe they're going to end up doing worse. I think in a recession you tend to see the hospitality business decline. Going in 2007, I was working for a company that primarily raised capital for hotel investors. I mean, we did a lot of other things, but the main business line was for hotel investors and developers. You can imagine that business got crushed over the next year because where there was the difference in travel is quite a bit, and you don't have any set leases or anything in the hotel business, right? You could go from having great business today and it disappears tomorrow, right? But so this is something I think I'm probably a little more sensitive to than most people, just because I've been through that. But specifically for SDR, some of the things that I like to think about is, okay, this is one of the reasons why I'm really focused on the rent to price ratio, right? Because that is your revenue to price ratio. If you have a very healthy revenue relative to your price and relative to your mortgage payment and other expenses, well, then you have room for a significant decline and to still at least be able to break even, right? One of the problems with a lot of the STRs on Lofty, they're paying out a good yield, but it's really only because of the structure of the deal. The revenue itself is not covering the debt very well at all, and so we can see that that's why that number is one that I harp on so much, right? Like just trying to really understand like how much revenue is this property spitting out relative to how much debt the property could potentially have to handle, even if it's not at the moment. Another one of the things that I think that people don't think enough about is it a tourist market or is it an STR in a market that is, so for example, San Antonio, we have this is where I work, this is where I live and work. I'm in the real estate business. I have a small agent team. We only help investors find properties here locally in the greater, San Antonio market. And a big part of our business is selling short-term rentals. The This market is much different than, if you invest in a short-term rental here, it's much different than if you invest in a short-term rental in a ski town or in a beach town, right? Because one, it's never going to. So if you took every short-term rental off, if every single one of them went out of business and got put on the market for sale, it would be detrimental to home prices here, but it wouldn't be any, it would be The last time I checked, we had somewhere like 5 or 6 thousand short-term rentals. We probably have more than that here now. But at any given time, we already have 10,000 homes listed on our MLS. So, it's not even like equivalent to doubling the inventory on our market if literally every single short-term rental was listed for sale. Well, if you go to a lot of beach towns or ski towns and places that have are tourist markets where that's the majority of the homes are being used as short-term rentals. Well, all of a sudden in a downturn there, the prices, there is no other use for those homes, right? There's not these owner occupants that are going to buy those up. And so that's one of the things that I like to think a lot about. And there are markets like San Antonio where you can do well with a short-term rental, even though it's not a quote unquote vacation market. On top of that, and the next thing I want to mention is the cyclicality of the market, right? Because one of the things, if you have a market that makes all of your money in like 3 or 4 months, which these exist, right? Like if you think about like beach towns in Maine, I happen to grow up in Maine, right, pretty close to a beach town, and every single home rents out for like three, four, $5,000. Um, I guess a week now. I think it sounds crazy. Well, I mean, some of the big beach houses, maybe a week, and maybe even more than that. Is that right? I don't know whether it's a week or a month, but crazy amounts of money for 3 months out of the year, and the other 9 months, a lot of them just sit vacant the whole time. There's not, there's just not even a demand for them for the rest of the year. Um, well, if you have a recession and it's a 6 month recession, but it happens to cover your whole your the good part of your cycle, you lose a whole year of revenue, even though the recession didn't actually last that long, right? And so that's one of the things when you have that cyclicality, and this, that risk exists whether or not whether or not it's a recession that you're jumping into. It could, it exists. Um, for any other reason, right? If you had a loss at the property, some major repair that you had to fix, if you're wiped out for a couple of weeks of your only 2 or 3 great months, that's a problem. There's definitely a few deals on Lofty that I noticed that's the case. That they have, like, the summer just dominates, and then the rest of the year is like maybe not even covering, property taxes, or, but, just very much weaker. And so that cyclicality, even, if you could have that or not, and have the same level of income, I would always choose to not have that, right? Now, one thing, because of the way properties trade on Lofty and tokens move up and down so much, you do have a lot of people um, trading into those quite a bit in the downtime and then selling out when it pops. And I mean, I think that is it's an interesting strategy, but you could get stuck holding the bag there if your plan was short term and you bought when it was low, and then, oh, this summer, oh, we there's that's when the recession hits, and okay, now you're actually holding for another whole year before you get any income or can sell. The other thing too is, if it's a flying or driving market, like this is one of the things that we noticed. Um, you know, a couple different times over the time I've been in real estate. There's been periods of time where consumers chose not to fly as often. Flights got expensive or incomes were down. And so there are a lot of markets that tend to just be, okay, a lot of locals drive there for vacation versus there's a lot of people flying in. And so I think if you have those fly-in destinations, you're at a much higher risk in situations where you have that sort of downturn. And then the last thing is, and this is one that I kind of don't like as much, but it's something a lot of people do, is they're like, okay, is there an alternative use for this property, right? Like, would this work as a long-term rental? And I think that the answer is almost always no if it's a great short-term rental. Like most markets, there's a certain property type that's, like, for example, in San Antonio, if you have a 5 bedroom house with a pool, um, and you kind of go all out with amenities in the backyard, maybe a pickleball court or, putt putt, and you have a game room inside, and you have a bunk room, and you really do the decor nice, those types of properties really dominate here, and that's what over the last couple of years have been the bread and butter of my team here. But I think that if you couldn't use that property as a short-term rental, you can't rent it as a long-term rental. Like you're going to lose money as a long-term rental. Most of those are not going to work as a co-living or something like that if you changed it to a co-living situation. So the alternative is okay, I've got to sell it if it's not working anymore. Like I said, a lot of people are okay with that here because just because there's a downturn in short-term rentals doesn't necessarily mean there's going to be a corresponding downturn in housing prices because they just don't make up a very large portion of our market. But it is, it's one of the things that I've known a lot of short-term rental investors that say, I want this to at least break even as a long-term rental. Um, I think that it makes sense when in theory, but when you actually look at like, okay, what type of properties do well for both? They almost just don't exist. At least in my market, they really don't exist. In some markets, I think if you squint and you really stretch your numbers, I think you can get there. In some markets, maybe they just work completely and it's just juicing your returns a little bit. But it's kind of like saying, okay, I'm investing in hotels and I want to make sure this hotel would also work as an apartment building. And nobody ever does that, right? Like you're in, if you're a short-term rental, that's the business you're in. The home that you pick for that's going to do the best for that is very rarely one that works well. So that's an instance where I am definitely giving up some downside protection in order to make a business plan that works well. But I just think it's so drastic, so that sometimes that's where I'm at with that. So, I mean, basically, I think those are the main things that we can control, right? Like that we can put in place to counteract risk. We like I know it's fun, to guess about when or to, fantasize about when this crash is going to happen and we're all going to buy $3 homes, or interest rates come down and they're 3% again. I mean, wow, that would be really exciting. Um, but other than, daydreaming about that stuff, there's nothing productive to be done about it, right? Like the things that we can do is be defensive investors, find deals that, are structured that give us a decent return while still being structured in a way that we have a lot of downside protection. This is one of the reasons that I'm very focused on the fundamentals of the deal. It's one of the reasons I really like the discounted token strategy on Lofty is because those are some of the only ones on that platform that I feel like, okay, I'm really just looking at the safety here being my liquidation value. Um, and normally I'm buying at a very deep discount to where, okay, I don't think that, unless yeah, if we go back to 2008 prices, then maybe I'd get hurt on some of them. But even some of them, even a pretty big 15-20% crash would result in, okay, maybe a small loss or maybe I break even, depending on which one, which tokens they were. um, the other thing too, when you do look at the speed of housing prices, and this one actually doesn't really have the years set out well, but they don't move. Oh, I think that maybe each of those blocks is 10 years. I don't know. They don't like housing prices don't move that fast. Like, yes, there was a large decline around the 2008 time period, but it wasn't like they dropped 30% in 2008, right? Like, and maybe in some markets they did, but no markets that I'm aware of, right? Like they dropped over a longer period of time. And so if you have, if you do have that deep cushion of equity and you see that coming, you can just sell, right? You can sell now. Maybe that sale takes a little bit longer. But if that's the real worry, or if it's a property that, the one reason that I think I care about all these things that I talked about for a long-term investment is the goal is to just never be a forced seller, right? And so, uh, and that's what all of this stuff is about, right? To make sure that I never have to be a forced seller. Having the really low basis makes me not care if I become a forced seller, right? Or be okay with it because I'm not going to get hurt in that situation. And so that, that's the other thing I think about. Um, It's one of the reasons that I'm really okay with, some of the mogul properties. I've sort of hemmed and hawed about I'm getting some good country phrases, I think, living here as long as I have now. But, like really going back and forth about like, are we paying a little bit too much for this or not? And at the end of the day, I become comfortable with it because I do think they're taking a very conservative approach to the way their reserves are, their debt coverage ratios. They have a professional team in place to handle things if things go bad. Um, they're really looking at the condition of the like all these other things, the markets they're in, all these other things make me feel like we're just not going to be a forced seller there. Like they're creating, sort of a robust protection. Even their approach to insurance, I think, is a little bit more conservative than mine has ever been. And so, I think all of that makes it so you know, there's a lot of protection against being a forced seller there. And then if we are to, it's not like we're going to get completely wiped out because, we do have relatively low leverage. None of them are 90 or 95% levered. They're all like 65 or 70% levered. So in the instance where, okay, maybe you did get liquidated, um, it's not as if you should get wiped out in that scenario. It's possible, but I think that risk is something I can live with. Anyway, I just wanted to talk about that, right? Try to pull the focus back onto the things in the properties that we can look at. Really try to ignore all this noise about when is the crash coming, what are we going to do about it? Like, I mean, there's people that are like, oh, I'm trying to get, raise a bunch of dry powder right now. Like, I think it's always good to have cash on hand, to have a pretty good liquidity ratio where you've got a decent amount of money. I would caution some of the people, especially some of the guys I talk to through the Lofty Discord, um, have their liquid funds in places, and it is liquid, so I don't know, but have it in places that can instantly crash in the in an event that things go wrong, and so it might not really be there to the extent that they need it to be as a reserve. And yeah, I'm thinking about like the people that have, are putting their reserves in Bitcoin or keep all of their extra cash in some sort of cryptocurrency. We've seen that there's cycles of that, right? And so I would hate to see like, okay, we're having a problem with the real estate. You need some cash right now. And oh, also our crypto's down 20%. So we're taking a hit on that to be able to spend it to fix, to replace a furnace or whatever we're doing. Um, not to say you shouldn't invest in crypto. I mean, I think it's a perfectly legitimate thing to do, but I think holding your reserves in crypto is a terrifying thing to me. Um, I'm only okay with it as if it's a small portion of your reserves. It's like the amount that some of them would have voted to send back anyway, maybe. Um, and at the moment, I think it's really just one property that's doing that. But anyway, I think that that's I just want to go back to reserves one more time and just really like 5,000 or 10,000 or $12,000 reserves for a duplex is not very much money. Like 25, 50K I think is like perfectly like we're these are not like overfunded reserves like the when we're just like spitting out trying to create some yield and boost the token price. One, it's a temporary thing, right? Like, okay, maybe I'm getting that cash back and I can use it elsewhere, but if we're doing it to the detriment to the long-term survival of a lot of these properties, it's terrifying. And I think that if you look at the performance, like it's really the case that that's been, been a problem for a lot of the DAOs is, they don't have the reserves when they need them. They're taking loans or they're making really just suboptimal decisions, making sort of like band-aid fixes. And can we just wait until this for that to happen? And so I think avoiding all of that makes a lot of sense by just every month that we cash flow, a certain percentage of that goes back into rebuilding reserves. And the goal is like, I don't want to pay it out just because we hit 5,000. Let's not pay out everything above that. Like that seems like a stupid low number to me. Like it's easy to spend way more than that on a tenant turn, and if you have multiple units, then that's really a problem. Anyway, I think that is all I wanted to say about this stuff today. I'm going to tell you about the book one more time. I don't, I think you should buy this and read it if you haven't already. I should probably put an affiliate link or something. Um, I feel like a lot of the people that I talk to don't really have a good sense of risk, and like, I feel like some of the younger guys, and I don't mean to be condescending about it, referring to you as younger guys, or some of the newer investors who have been investing 5 or 6 or 7 years are super cocky and don't understand that that is just, you haven't been through a real down cycle, and things can get much worse and stay worse for longer than I think you expect. And so, credit cards are not going to necessarily, your credit limits might disappear. Even if your income or in credit score doesn't change, credit cards can take away your credit limits. So that's not a good reserve. I saw that happen to a lot of people in, the 2008 timeframe. It happened to me. I had taken out a bunch of credit lines thinking, okay, this is going to be my cushion. I was also like over 100% leveraged on my properties at the time. Like I was, very, I only made it through that time period with a whole lot of hustle. The fact that my wife also has a full-time job, and that I hadn't been doing it for too long, so I didn't have like tons of properties that I was feeding. But yeah, credit lines will disappear. People that think, oh, my home equity line of credit, I'll just pull from that. I saw people get their home equity lines reduced, right? Like, because the banks all have these material adverse change clauses in their loan documents, and they can change your limits at any time, right? So that is not this having a home equity line of credit that you can pull from is not the same as having cash reserves. Having a lot of credit cards, again, not the same as having cash reserves. There's just all these, uh I don't know. I get worried. Some obviously I've had a couple conversations with people lately that really worry me. Um why I really wanted to jump into this, like, okay, these are the things that we can do to keep our risk as low as possible, because I think, we already are seeing some cracks in the economy in some markets, and a lot of properties not performing like they were a few years ago. So anyway, that's definitely it for me for today. Tickle the like button, please. Hit the bell. Do the thing. Uh, and then nobody actually did the comment for me yesterday about the little thing that popped up. I didn't remember to do one in this video, but if you saw that and that worked, let me know. And if it didn't, please let me know that as well, because I'm really trying to figure this YouTube stuff out. I'd like to, it's a lot of fun for me, but I'm also making a whole bunch of friends with people through this. And I think that it's like nobody wants to sit here and listen to me talk about this stuff like over the phone or something. But I think that like being able to share the thoughts and have some sort of common ground on either properties that we talk about or strategies or whatever, has been just a lot of fun for me. So hopefully that's working out for other people. But I think that I'm sure I could make these videos a little bit more, um, tighten them up a little bit, make them a little bit, denser as far as usefulness goes. Uh, but also too, like, hopefully, really just trying to start the conversation most of the time. And then a lot of you guys send me DMs or talk to me in the Discord or in the comments, and I really appreciate that, because that's all I'm trying to do, right? I'm trying to make this whole community a little bit better, make us, help us all share thoughts about stuff and whatnot. Okay, that's it for me for today. Until next time, I'm going to keep making mistakes so that you don't have to.